Okay, I'm going to go ahead and get started. My name is Dan Quigley. I am the Senior Vice President at Kirkpatrick Management Company. Tonight, we're going to talk a little bit about insurance 101 and risk management. I'm going to start by introducing myself and what I do. As a Senior Vice President of the company, my job is basically operations for all of the community associations that we manage. As far as I work with the CAMs, work with your managers. I work with the accounting team. I work with the compliance team, customer service reps, everybody out there. So I am the person that you're going to call if you can't get anybody else to help you out. That's me. A lot of you already have this, but I am going to give you my cell phone number in case something comes up ever and you need to get to the top of the list. My phone number is 317-847-0016. It is a company cell phone. You guys pay for it because you pay for my salary, for my phone, my car, everything. So I work for you. So if you need to get a hold of me, that's the way. Try your cam first. Try whatever the lines you're working. But if you need somebody, I'm there. I'm going to introduce another member of Kirkpatrick Management Company is Kelly Quigley. You'll recognize the name. She is my wife. She used to be Kelly Soto. She is now Kelly Quigley. But she is with us. She is most of you have talked to her before. Her job is she is the director of client relations. She talks to board presidents. She has that is her job all day long, every day, just to work with the board presidents that we work with. The idea is we want to catch problems when they're small. If something comes up, reach out to her. Something you don't know the answer to, something maybe your cam is not getting back to you. Maybe you just are not gelling. Hey, maybe you just need to find out how to get a hold of some different things. Kelly actually is been in the industry for around 20 years. She's done high rises, she's done HOA, she's done condos. She started in Colorado, and when she graduated from UC Boulder, and she has been in and out of the association management business ever since. So she knows a little bit of everything. She'll tell you she started when she was four, but she has been doing this for a while. So that's kind of the nice thing. A lot of people can, anybody from Brad Hessman, who's got a multi many unit condo. She can hopefully answer questions just as well as she can for someone who's in an HOA and has a pool problem. So we'll just she's gonna get your answers to you, get your cam straightened out, get them all back to you, and try and wrap it all up in a nice little bow and clean things up. Our guest speaker tonight, our expert tonight is Travis Round. Travis is the managing partner of Steffi Insurance in town here. He has been working in this industry for over 22 years. He's been the president of the CAI at least once. I know he's a very involved in the local CAI chapter and the national chapters. He is about as much of an expert as you can get in HOA insurance. This is what he does. He's seen it all, done it all. He and I have worked through fires together. Haven't had floods together, but we've done just different projects here and there all over the place. And he's going to be a good source tonight. What we're going to do is we're going to take about an hour of your time. We're going to go through. We have questions. We have we've got kind of insurance basics. We're going to start at the beginning and work our way all the way to, hey, what happens if I can't get insurance? So we're going to kind of go the full gambit tonight. If you have questions that you would like answered, specific questions, and you can write them in there's a button at the bottom which is question and answers. You can write the question in there and we'll get to those. If it's fitting in the middle of our flow, I'll go ahead and ask Travis as we go. But otherwise, we'll stop at the end and ask some questions. You can get more specific. Um, One of the things is Travis is not going to know your governing documents. He's going to be able to get very, general questions as far as whether you're a condo, you're a PUD, whether you're an HOA, but he's going to be able to at least get some ideas from you. But we'll go ahead and get started. Travis, thank you very much for coming out tonight and giving up a beautiful Thursday night.
No, I appreciate you guys having me. It's going to be a good time.
Yeah. Basically, so tomorrow, Alyssa, who is our marketing person, she is going to send you over this PowerPoint. She'll send you over a tape of this presentation, and it'll also be uploaded onto our YouTube page. So if anything comes up and you're like, what did he say on that? Or what's the questions? You should be able to get that tomorrow. I'll get it tomorrow. Let me put it this way. I will get it tomorrow. You'll probably get it from me on Monday. Is usually the way it works because usually I come back the next morning and have just a couple things that hit me. So we will go ahead and I'm going to go ahead and did introductions. We're good. Understanding the essential insurance types, introduce basic risk management, and then discuss the trends. So Travis, just I'm going to kind of ask you questions. You've seen this a little bit, but where does somebody new on a board, where do they begin with insurance? What's the first steps when they're looking at insurance for their HOA?
Yeah, the first thing we always run to, and I treat it the same way as getting new onto a board is kind of like a board coming to me for the first time to want to talk about their association. The first thing we look for is we want to review the governing documents. If we want to look at the bylaws, we want to look at if they have covenant and restrictions because that tells us how the association is supposed to run. Tells us the responsibility of the association, not just even as a board member, but even as a unit owner. So that's the first thing that we always tell everybody is, you get them. We understand there's a lot of documentation. It's a good way to fall asleep at night. I'm not going to lie. I do read a lot of these. There are some that are very interesting. There's some that's very boilerplate. Indiana is special that not one is ever the same. So you got to make sure you take the time to to stop and read that. And then the next thing is if your board doesn't know, then reach out to your insurance specialist. Reach out to your property manager. And we always tell property managers is try not to put yourself in the way of the firing squad when it comes to the insurance questions. That's what you're paying us for. That's what we're here for. We're open. Call and ask questions. There's no stupid questions. This is what we do. It's not what you guys do. But look at the governing documents first. That'll get you in the right direction of where you need to be.
And as you were saying, there really isn't. None of them are really the same. There's always if you go from a condo, not even every condo is the same, and half the time condos are really PUDs, and so there's a different thing there.
Yeah, we run that all the time that people call us like, well, our realtor or my mortgage company told me it was a PUD and you guys have it as this. And on the side of insurance, the world is different that, when it comes to taxes and how this set up, you can have a single family, you can have a PUD, you can have a condo. We don't deviate it that much. We go right to the documents because it's either we got to take the building or we don't have to take the building. So we don't go as deep into it as what you'll see for taxes and for closing. I think that causes a lot of issues. And we've had those over the years of like, you keep saying that we're a condo, but we are a PUD or we are this. In behind the scenes, there is a difference. But when it comes to the insurance side, it's either we have to protect the building or we don't protect the building, and our documents lay that out for us. So knowing your CCRs and your bylaws is important.
Okay, all right. What about state law requirements? Are there any minimums, or is there anything in your industry that you guys have to keep in mind on that?
There's right now, unfortunately, because we don't have like if you go to Illinois is very cut and dry. Like they tell you what you had to have and what you have to do. Indiana is still a little bit of Wild West on that. That it's if any builder or anybody has a good friend that's an attorney and they think they know what they're doing, they can draw up what they want. There are times with some of the largest builders in the state of Indiana that I've gotten their CCRs and gone back to them and said, "Hey, you contradict yourself. We have an issue with here. This doesn't coincide with insurance." And I've been able to sit down with those developers and go, you can't do this. This makes no sense. I know what you're trying to do, but we can't insure it that way. It's absolutely impossible. The biggest thing that you're really going to see when it comes into is they're all going to recommend that you have your liability insurance, that you have your directors and officers, and that you have, some crime or, money coverage. Then after that, they kind of just get pretty open of going, if you feel it's necessity, you can go and get this. So they stay pretty lax. So make sure you know who you're talking to and dealing with, and what you have and what you don't have.
Okay. I think I feel fair which way. So I'm kind of going to go over the general types of insurance if we can. I put a little bit of everything on here just because you can, what's the difference, and just kind of if you could give us some definitions and like general liability insurance, what it covers and why it's essential, what that, and then the directors and officers, and just give us some ideas on that if you
Yeah.
don't mind.
Yeah, so the way we look at it every time we start, first and foremost, after reading it, we look at property first. What do you own? What are you responsible for? What does the association is responsible to maintain? Whether it's an entry wall, if you're a single family HOA, whether you have entry walls, who owns the street lights? Who owns street signs? Do you have fence throughout the community? Do you have a playground throughout? Do you have basketball courts, swimming pools, clubhouses? That's all your property. When you get into, more of your condo settings and that stuff, then it's, what structure is it? A duplex? Is it a quad? We have single family. So we get into all that of what is considered the true common area of the association, that if it gets wiped off the face of the earth tomorrow, that we got to put it back. Then we switch into our liability limits. That's going to be the liability of anything that happens from somebody walking on the common ground and being hurt, injuries off of the playground, injuries out of swimming pools, off of the tennis courts, the walking path. So we look at basic liability over the entire premises, for opportunities at work there. Then we dig into, you have your directors and officers, and that liability limit should always match your general liability limit. Traditionally, your guys' governing documents are going to say you have to have $1 million minimum of general liability. Your directors and officers should always, go to match. And that's kind of like your errors and omissions, like we have on our side for an agency owner going, hey, if we tell you we're going to do this and we mess it up and it comes back and causes something, here's what it is. If the board makes a decision to vote to go, hey, we want this to happen, and we get sued, that's where your directors and officers is going to come into play. That protects your actions as a board for being a volunteer. That's the only thing that's going to protect you as a board for being a volunteer. So,
So what about the volunteers that aren't on the board? What about
so
Mrs. McGillicuddy that wants to go out and pull branches and cut branches and dig up tulips, and is that covered under directors and officers, or is there other something else they should be looking at?
Well, it can be under directors and officers, because you can have volunteers covered if it is under the direction of the board. Now, if she's just going out and decides she wants to do it on her own because she's special and she doesn't like what the landscaping crew, she's on her own. The association is not going to do that. And I know nobody's ever had that on this call. But the other big asterisk that you have to do is you have to read your directors and officers policy. There's a lot of what I will call just boilerplate D&O endorsements that are put onto policies, and people always go, well, yeah, I got it for, yours is $1,200, $1,400, $1,500, and I got it put on our policy for $200 or $300. There's a substantial difference in the language of those policies. Not every D&O definition includes a volunteer as a member of the board. Not every definition of D&O can even include your spouse for coverage for D&O, because somebody has a Facebook page. Miss Quigley gets on there and she gets a little snippy because somebody took a shot at her baby Danny, and not to protect him, and then now we have a lawsuit. Not everybody is going to protect Kelly. So you've got to read that documents, and you've got to ask those questions. They're not cut the same. General liability is pretty straight in there. Directors and officers is all over the place. So you have to know what you're paying for. But yeah, if it's under the actions of the board that they vote for Mrs. McGillicuddy to go out there and take that stuff out, and somebody sues because they don't like that she removed it, she's protected. But again, make sure you read the documents, the endorsement
Okay.
does.
What about so a lot of the larger, now you're an independent agent, so you can represent all kinds of people, correct?
Correct.
So what about now some of those larger, like when you have the larger firms, and the larger insurance companies, they have like it's almost like a rider sometimes. Is that what you're talking about for their
Yeah,
directors?
yeah, they endorse it on, and it'll be, yeah, and that's what you usually see, and that's what we get a lot. And I'll be honest that, my agency, we will lose more business because if we put it out there and we show that we go through an outside carrier to get a much broader, more comprehensive D&O policy, it'll cost you $1,200 to $1,500 depending on the size of your association. And people are like, well, X carrier, and I represent Erie and Travelers and Nationwide and all this stuff. They all have their own D&O form. They add it onto the policy, like you're saying, like it's a rider. It's an endorsement form that goes on, and it'll cost you $200 to $500 depending on the size of your association. But it's not nearly as broad as it is, going out to our larger people that just specialize in that. When you get it through your standard carrier and they endorse it on, it's more as it's a goodwill. It's a Band-Aid. Don't get me wrong. There's coverage there. If you're purely shopping for coverage, or if you're purely shopping price-wise, that's fine. Go and get it. And that's usually, unfortunately, and I get it. I do too. I'm a consumer at the end of the day. My checkbook only goes as far as it can go. But when there's a difference of, you're spending an extra 700 to maybe $1,000 a year to have much more coverage. And I know it'll never happen to anybody in this call. They'll never get sued. Everybody is perfect. I get it. The other thing you have to take in effect too is that D&O also covers your property managers, so it also protects them. So we are all about being cost efficient, but we are also coverage first. That we are, even though majority of the time it's a property manager that brings your association to us to look at it, we want to protect the board first. We also have to protect the property manager for acting on the behalf of the board. Make sure you read the policy language and make sure that, Dan and Kelly and everybody over at KMC is protected by the decisions that you are made as well. Because, you guys have a financial obligation there too as well.
Yeah, and I think we try and push a second policy. I mean, I think not. I mean, a separate policy, just because it's, as you said, it's broader, it's more specific and broad. I mean, it just gets out there, and instead of just being a little, it's the other one's fine for some instances, but especially a condominium association, a large association with a pool and all the different things. But it's just it's something I know Kirkpatrick we do pay a lot of attention to is the DNO.
Yeah, you want to ask a question, call and talk to your insurance agent and just ask them like, hey, if we get sued for, discrimination lawsuit, fair housing, do I have coverage? The majority of your stamped, carrier endorsed D&O excludes a discrimination charge. And I hate to say it, but over 90% of all lawsuits that I see that come through have a form of discrimination tied to it. And if
Yeah.
they feel that's what it's based to, well, then not everything is insurable. So you guys better have some deep pockets to pay the attorney. So there's things there to look for, a lot of non-monetary claims. There's things that you just made a decision that costs nobody money, but they're just upset at you and they're going to sue you just to sue you. Some of those policies exclude non-monetary just to stand up in court and go, hey, we're sorry we upset you that, we painted the entry black and you really loved it brown for all these years. We're sorry.
Yeah.
So there is some differences there.
Okay. What about workers' comp? That's kind of, I think it's misunderstood a lot on our end as far as we try and make sure all of our vendors have workers' comp and make sure that that's important. Can you kind of tell the viewers here how that is important to them and whether they should have that also?
Yeah, this is probably the hardest one that we read inside the documents. That's like, as a suggestion, or like work comp if you feel it's, appropriate. The first trigger for anything for work comp is, does the association truly have any employees? Do you have somebody on payroll? There are associations out there that have, an independent, management firm like, Kirkpatrick, but they'll have a full-time handyman or somebody like in the community every day that's in there doing stuff and they pay them and that. You have anything like that, immediately you're triggered, you're required by the state of Indiana to carry workers' comp. Now, where you run into the other circumstance is going, hey, we don't have any employees. We hire Kirkpatrick, they take care of all of our stuff. Well, technically they don't. You vote upon who your documents, who you're going to use as a vendor. Kirkpatrick makes sure that the certificates of insurance in place. There should never be any contractor or any vendor that comes on your property to do any sort of work that doesn't have workers' comp on there. You get a lot in Indiana, you'll get the small guys that are like, well, I'm a sole proprietor, so I don't have to carry. I file with the state to do a waiver. The waiver with the state is just saying, I agree, I'm going to admit how much money I make and I pay taxes on my money. That's all it is. It doesn't clear you off of anything. So if your vendors coming in all have work comp, that should clear you out of a lot of stuff. Excuse me. The only time the association truly comes at risk is if you knowingly hired me and you knew that there was a big exposure for what you're asking me to do. You're like, hey, I think the roof's a little soft, but for sure that dude's about to fall in and you don't say anything to me. I climb your roof, I fall through, then I'm going to sue you. Now, for that aspect, our liability would kick in, but work comp is the only thing that's going to cover loss of wages or anything along that line. Do we see a lot of it? No. Do we have some documents that require it? Yes, you'll pay $1,000 a year just to have a policy. And we have some that carry it because they can also carry and cover coverage for volunteers. We have communities that are very heavy in volunteer activities of re-landscaping the entries and doing all this. So they carry up policies just to be safe in case somebody would get hurt and come back to sue them for that while they were doing those. I will honestly say in the state of Indiana, I have a very small percentage of associations that carry work comp, by the standards that's set there. But, if you're hiring the same vendors over and over and over again, I don't let them on in my house without having a certificate of insurance showing it, for my own financial responsibility reasons. I know Kirkpatrick does the same, and that's, if you guys are sticking to that, then you should be okay.
Perfect. One question, we do have, what about, sometimes neighborhoods have board members out there, this is just general came to my head, sorry, out watering the plants, because they're not gonna, out there watering plants and things like that. That, if since they directed this person to go out there and water the plants, they should be covered under directors and officers.
Correct. And again, it's if it's
That's a look, but
yeah, if it's on the biggest, as long as it's going, hey, the board is okay, because every association has, the last one I lived in, we had over 800 homes. We had so many little subcommittees that were in there, and
yeah,
you had the landscape committee, you had this committee, and if they voted upon it, and the board voted upon it to go, hey, I live close to the entrance, I don't mind running my hose out there, and I'll water, and I can do that stuff as long as it's voted upon. Yes, again, talk to your agent to make sure going, hey, we have volunteers that go out and do this stuff. Is it okay? Do we have coverage in case they get hurt? Worst case, they get hit by a car. We've had that. People out working the entryways doing those beautifications, and then they get hit, get backed up by a trailer or a truck. We've had those. So there are circumstances that come into play. Just to be safe, have a quick conversation and go, yeah, you're covered as long as it's by the
okay.
board, the volunteer, then we're fine.
Good, good. Thank you.
Mhm.
Kirkpatrick Management has a very robust cyber policy. Do you, because we have a lot of information, right? I mean, that's what we do a lot of that. What about the HOA and the board members that are here? Is that something they should be looking at, or is that something they can count on us, or where do you fall on that?
Yeah, by default, what and this is stuff that we even as an agency have had to have make adjustments because this has been around forever. One of my largest carriers got hit, a month ago, and we've been dealing with it. It's out there, it's everywhere. Um, you would think the last spot they're going, hey, a homeowners association, really? Um, they're just looking to lock data down. So majority of spots anymore, a lot of carriers are automatically, even on the association side, is automatically putting in a small, what they would even call a cyber package. Um, because there is responsibilities that if you do get hit, the first and foremost is going, well, Kirkpatrick holds everything. We don't even have a database as a homeowners association. Like I don't have access to that. We have nothing. If they hit Kirkpatrick is responsible for all that data. It's their cyber policy is first and foremost. What comes in the back that we've changed and make sure that now even we're putting a cyber package on to all of our associations is going guilty by association. You didn't do it, but it doesn't mean somebody doesn't sue you. So there's a reaction aspect and there's a response aspect and a notification. So all the policies are set up that way that even initially, if it gets hit, if there's a cost of sending out the notification to everybody in there going, hey, we know there was a cyber hit, there's this. Well, then we get a response point of going, okay, do we have to provide, um, you know, credit monitoring and all that stuff in the background to make sure it gets hit? Again, Kirkpatrick is first and foremost, and association would be secondary. Doesn't mean you won't get named in it. They would have to prove that the association was negligent in the aspect that they got it. And if everybody's like, we don't even have a server on site, we don't have access to this, we don't have credit card information, we don't, as a board member, I'm like, I have a PDF of who all lives here, but I don't have any of their personal information.
Right,
We
right.
would get out of court of that fairly quick. But on our side, again, that is an endorsement that most carriers you can put on now. You're talking maybe $150 a year.
Okay, that's not a bad deal then. Okay.
Yeah.
We have down here property insurance, but that kind of goes with your general liability and
Yeah, your
hand in hand,
property is
right?
what, yeah, if you're covenants restrictions, common area, what's the definition of common area? Whether it's street lights, street signs, which is one of the biggest things that we miss, that I see when policies come to us. Associations don't take into account that you own the street lights and street signs a lot of times. I know Duke and everybody else sometimes are like, hey, we lease them. The biggest question we ask for that, and we'll get into this later on too, is going, yeah, but if somebody smashes that, who has to replace it?
Yeah,
Street lights aren't cheap.
exactly. Exactly.
So property is anything inside those documents that says, hey, it's what is considered the common area. So, Yeah.
Sometimes our when we our closing department will ask, and Fidelity Bonds Association has a Fidelity bond. If Kirkpatrick has a Fidelity bond,
Yep.
what are they talking about on this thing? And is ours good enough for most of this stuff, or what are you thinking on that?
Again, my responsibility first and foremost, and every agent's responsibility first and foremost, is protect the association, not so much Kirkpatrick. So,
I understand. Yeah,
in circumstances like this goes both ways. So, Kirkpatrick has their own fidelity bond in case they find out that somebody was skimming money off the back end. And a lot of times you'll see it show up even called like employee dishonesty
there
in
you go.
in the
Okay, I should have
world.
put it there,
Yeah,
Liz.
in the world on our side of the stuff, you won't like we have carriers that we will go get a true fidelity bond for. Once the limits get big, like I've got a couple that I've got bonds out there that are for a couple $1 million. Like some people are sitting on a lot of cash. A lot of them don't sit that heavy. So a lot of times you'll see employee dishonesty, and that's what you think about is somebody who stole from you. Um, Kirkpatrick has it in case of an employee inside would steal from you, or if they would steal from Kirkpatrick, if they were skimming off the back, making fake vendor invoices and paying them out, which you guys never had the services done. I've seen those. On the back end, I've seen boards who have, certain writing powers that they don't always go to the property manager that they can write checks for, or they have the debit card, or they're slipping money off the back end and stealing there. That's what you see a lot. And that's why I'm very cautious about writing self-managed associations because we see a lot of that in self-managed. So
Me
we're
too.
very particular what we take there. But so that goes both ways. And the way the policy is written on our side is Kirkpatrick has one, but I know for sure there's not a single management firm that I insure individually that carries a fidelity bond or employment practices, employee theft coverage under their policy to cover every dime of every association they manage. They don't, So what we do is make sure that, hey, if you have $150,000 in reserves and operating funds, we're going to give you coverage for like 200,000, maybe 250, because if you're constantly, if Dan's telling us like, hey, Travis, these guys are putting money away every month, they're stacking it back, they're growing fast, then we want to be ahead of that because if somebody gets their hands in, whether or not be your bookkeeper, the person at the bank, somebody over at KMC, whoever it be, starts stealing off of you and you don't realize it, we have coverage to protect you too. KMC is not going to have that protection if it's taken out of the bank. Somebody at the bank that's going to do that on your association. Their policy is not going to protect you. Our policy would. We also protect you in case the acts of the manager or somebody would do something to you. The kick to this coverage is you have to prosecute. Okay. If you just call and go, hey, yeah, but Dan's a great guy, but I don't think he meant to do it. But yeah, he took $250,000 from us. So I'm going, then
Yeah,
you need to
yeah,
prosecute. They're like, well, I don't want to do that to him. He took $250,000 from you. I
yeah.
didn't know. That's the only kicker. And I've watched business owners over the years struggle with family members of that kind of stuff. Like literally, a guy called me. He said his sister-in-law was writing checks out from underneath the business. And it was over $250,000, and he wouldn't prosecute, but he wanted me to pay the claim. And I'm like, I can't. You have to
Yeah,
prosecute.
that makes
So,
sense. That makes
yeah,
sense.
yeah.
I have a question on workers. Jerry Torr is asking, what about contingent workers coverage? I actually don't know what that means.
So your contingent workers coverage, like we will see that a lot too, that we will have boards pick that up as a contingent would be on a point that, we're hiring these contractors and God forbid their policy lapses and nobody catches it. Or they come back to try to say, hey, the association is truly negligent for my worker getting hurt. You can do that. Like again, a lot of times when we write a policy like this, if they don't have an employee that's truly there, the policy is like $850 to $1,000 just to say you have work comp just in case.
Okay.
Yeah.
All right. Thank you.
Mhm.
And umbrella. So what's an umbrella to all these things? I mean, what's that really? I mean, we know what an umbrella is, but what's it do as far as insurance?
So your umbrella is purely liability driven only. Okay. So as he says, we know what an umbrella is. Think about it. If it's raining outside, we pop it up. It's an extra layer of protection so we don't get wet. Well, that's also an extra layer of protection in the insurance world to keep them out of your back pocket. So your general liability, your liability limit is first and foremost. Your director officers is first and foremost. Well, you have $1 million worth of coverage. We have a drowning in a pond. We have a swimming pool issue. We have a playground issue. You can name a million of them that we've all been sued for. Um, you lose $5 million. Court goes, it's $5 million. You're negligent. You got to do this. Most of the people only have $1 million per occurrence for general liability. So where's the other $4 million going to come from? So now we get into the wonderful world of special assessments, and which is going to just help property values and all the wonderfulness. So what you can do is no different in your personal life. You have liability for being a homeowner and for out there driving a vehicle. Those policies are first. You buy the umbrella to go, hey, if this policy runs out, I've got something up here that add more coverage to me. Traditionally, those will, like, we have a standard carrier that'll start for an additional $1 million, and they'll go to $10 million, no question asked above it. So, you're usually going to start about $500. You go to 10 million, couple thousand. We have one carrier I can go to 100 million. We do stuff on the East Coast that if we wouldn't offer 100 million, they would laugh at us. But again, it's just an additional layer of coverage. I see it every which way. I have associations that are going, hey, I don't have a retention pond. I don't have a swimming pool. I don't have a playground. Literally, I have a $10,000 sign out in front of our community. That's the only way you know you have a community. We don't have any common area. We don't feel we have an exposure that I wanted. Okay, that's fine. Our standard practice is we offer every association an umbrella proposal. We do it for two reasons. One, so you know it's available. Two, if you decide not to take it, we can all sit here and go, it was available. You decided not to do it. Unfortunately, if something does happen, we will go back to that to go, you were aware, we offered, you didn't take. Now, once we see, and I see it on all aspects, and I see it everything from, the average, I know your average median home anymore is shifting to different, but I see every price point where people understand and look at it to go, hey, we've got 4 retention ponds. We've got a playground. We've got a swimming pool. It's got a baby pool in it. We've got a basketball court. We've got tennis. Like, we have a lot of liability sitting out here. We have a lot of moving parts. That's money well spent. The worst one I ever had is I laughed at a community and made them sign off as we offered them a $5 million and a $10 million. And it literally was $100 difference for them to come from a $5 million in coverage to go up to 10 million. And they refused to buy the 10 million for $100. They had 7 retention ponds just to start the conversation. And I went, for $100, you don't want another 5 million in coverage to better protect you. And they said, nope. I said, please sign here. So that's part of that risk management that you got to start looking at and kind of going, okay, if this happens and this happens, and we get it. Insurance is like going to Vegas. Sometimes you win, sometimes you lose. And you feel like you're paying for something you'll never use. But when you need it and it's there, man, it's a really good thing to have.
It is. It is. That's true. We touched a little bit. Fidelity Insurance. Is that very expensive for an HOA?
No, again, those are cheap overall for what it is. The exposure is so low.
Yeah.
For usually, even if it gets endorsed onto the policy for like 100,000, you're only talking like $50. When you get into big bonds, even at that, like when we have to go out and get like large bonds, I don't have any of them that pay me over $1,000 for over $2 million in coverage. So average what we see, it's usually anywhere between $50 and $200, depending, between 100,000 and max like 500,000 we see on average. Across. They're cheap.
Good. So we all, we've got the policies, the different things. What do we need to, just starting for just, if Mrs. McGillicuddy again is calling, trying to figure out what do we provide? What should the management company, what should the HOA provide to them as far as documents, as far as, do we just give them a cover sheet? Do we give them the whole policy to take a look at? What's your general rule of thumb on that?
So are you just talking about like somebody that's already living there or somebody moving into the property?
They already live there. They just want to make sure they're going to take it and give it to their insurance agents.
Yeah. So usually what you do is anytime that we write a property, Kirkpatrick needs to be listed as additional insured. Now, like we issue out either an evidence of insurance or a certificate of insurance, which gives an overview of going, hey, if it has, 120 units, or if it's got 500 units and we're covering all this, like it'll show on there if, there's millions of dollars in coverages for buildings, or if there's just a couple 100,000 because it's common areas. It shows liability. It shows the directors and officers. We'll show the employee dishonesty coverage, or we'll show if there's an umbrella. That's the basics. And if you're going, hey, here's a certificate of insurance or your evidence of insurance that we get from the insurance company, and you have a copy of your covenants and restrictions, what we always do is go, hey, advise them to take that to their agent. Tell their agent to review it and see the figure out. You'll be amazed at how many of those agents end up calling us going, Travis, I have this. I don't have a clue. Can you just help me out on this real fast? Not a problem, we'll tell you.
Yeah.
We don't mind fielding those phone calls. And when people start going, well, do I have the accurate coverage? Like, do I need this? It doesn't mean if you have them call us that we're going to say, hey, I have to quote your insurance. I will never do that. First and foremost, we're going, if you want us to do a policy review for you real quick, we'll be more than happy to tell you. We will tell you right up front of going, hey, we just take the common areas. You need to have a regular homeowners policy, or, we take the walls out or the drywall out. Here's what I would recommend. Go back and talk to your agent about this coverage. We don't have an issue with doing that at all.
Okay. All right. HO6 insurance. That's
Yep.
who has that, and who, I mean, last year we kind of one of the hot items was people were getting a little bit of a rider to cover special assessments. Is that something you've seen at all, or talk a little bit about HO6 if you don't mind?
Yeah, so your HO6 is a world that you get into. Like on our side, we're reading and going, hey, the association is responsible for the outside of the building, foundation into a certain point. There are some documents that says, hey, the association has to be responsible for back to a builder spec unit minus the improvements or betterments made of a unit owner. There's some, it just says, hey, you update us that you made renovations, we had to pay for it. There's some, it just says, once the sheetrock is going up, we don't pay for anything going forward. So your HO6, what we tell a lot of people is the dumb rule of thumb is going, hey, if you take your unit and you flip it over, anything that falls out, you need to cover it. And then, on average right now, you're about $70 a square foot for a standard build interior replacement. That's going to take care of your drywall, your paint, your flooring, your cabinets, your countertops, your bathrooms. Again, depends on what your documents say. If you're a single family homeowner association, you don't have to worry about it. Now, you get into the world of the special assessments. Well, there's two aspects of a special assessment. If it's just a special assessment because, hey, we want to go and update the common area and it's going to cost us X amount of hundreds of thousands of dollars, so we're going to do a special assessment to everybody in the association so we can collect the funds and go do this, it's not covered by insurance. Okay. If you have a hailstorm, though, and we've seen this come into play, and we know that's the biggest argument is, well, the insurance company says there's damage, but there's not enough damage to warrant a new roof. One side of the slope of the building gets hit, but there's no damage on the backside to say. So, they're going to pay us money for half of the roof. Do we want to put half a roof on, or do we want to, come up with the money for the rest of it? And I've seen some of those get very expensive, and it's a very uncomfortable meeting for insurance agents and property managers and board of directors. But say they come back and go, hey, we had to do an assessment of $500,000. Your portion is $15,000. You can then go to your insurance company and go, hey, I need to have, because what they will call it on the insurance side is loss assessment. You want to talk about the cheapest coverage you can buy as an HO6. You can even buy it as a standard homeowners policy, but most of my carriers will go anywhere at the lowest is 50,000 to 100,000, and it'll cost you maybe $12 to $15 a year.
Yeah,
But it
it's just a
has to
good.
be a covered peril that happens in the association. If it's a partial fire, if you have hail, if you have wind, and they're going, hey, you have a good portion damage, but we're not paying for it all, but you guys want to put a whole new roof on, that's insurable.
Yeah, good. I think it's something we were talking a little bit about it at annual meetings at our condos and stuff. It was just kind of something people were looking at, and it seemed to be worthwhile for what everybody was doing.
Yeah, I would
Um,
change the verbiage on it from a special assessment to loss assessment, and
Loss
kind of
assessment. Okay,
because when you
good.
go and talk to your agent, that's what you're going to bring up to them and not going, hey, they're having a special assessment. Well, they're having a special assessment because they got to dredge the ponds. That's not insurable.
That's
They have a
okay.
loss assessment because they had a loss and they didn't get enough money to do the other stuff they wanted to do. Now you can get coverage.
Okay. One thing I do have one question from Jerry Torr before we go into risk management. It seems like this is on a lot of policy. It used to be, should we have hired non-owned auto endorsement on the GL?
Yeah, it's by every carrier I have now, it's automatically included.
Okay. It
But
seems
yes,
like it.
I would. And what that does is, Jerry goes out on the behalf of the association and goes gets, mulch or candy for whatever they were doing and gets into an accident. If he was
Oh,
if he was out on behalf of the association and somebody came to sue them, he would have coverage of that because he was a non-owned auto of the association. We have associations that will go rent a vehicle. Well, that's liability only, but that's your hired portion of it. But uh,
interesting.
every carrier anymore automatically has that built into the policy, regardless of the exposures.
14 years. I know it's nothing compared to you, but I had no idea what that was for. Now that makes sense. So,
Oh, I could
well,
ruin your life with
well,
it.
I'm glad I got to come to this seminar or learn some stuff. Risk management, I think you're probably, a little, we talk a little bit about that and what we're doing, but I think probably in my world, I always feel like this works more towards the condos and the stacked units or the mid to high rises. What is risk management for you guys? And just kind of talk a little bit about it if you don't mind.
Yeah, we run on both sides. I see the condo and the high rise and the mid levels and that stuff. We see it on both sides of going, let's understand the true exposures of the association, whether it's from, a high rise and looking at your water stacks and, that kind of stuff of, what does the service of those look like? And a lot of these people would never have a clue what those are, but it's the biggest water claims you ever get out of those bad boys. What's your sprinkler maintenance and that stuff look like? What's the longevity of your roofs? We look at it as both ways, and that's where a lot of your reserve studies you have on here help a lot of associations get their eyes open to what those exposures really are. Um, and I'll be honest, because there's a lot of people that own homes that don't pay attention to their own property of like, hey, I need to be paying attention to this, or I need to, some people just don't know it. They didn't grow up that way or just don't have a concern of figuring it out. Um, we see both. The multi units stacked and that stuff has a higher exposure. I get it, but the biggest thing is understanding the exposures of what the association truly is responsible for. So I'm checking with that, and that's where the reserve studies are a great spot to start with that because they can be uncomfortable. They absolutely can, but they will open the eyes up to an association, to a board, and to the unit owners of going, hey, there's a lot more here than what we think. And there's a lot more that we have to be doing than probably what we were doing. And also makes it not look like your property manager has three heads and always screaming at you.
Yeah, we can do that. I do have a question from a Deborah Newman. If you take a assessment, is that a hit to the homeowner, and will that follow them for 5 years?
Yeah. It will, but it's not hard. I'll be honest with you on our side, like anytime that would come up, and it's very rare we see it, that's something that we go to battle for, kind of going, hey, you didn't, it wasn't you, you got drug into it. But yeah, it will be on you for 5 years, but it's not as heavy as you had a water claim, or you had a hail claim, or you had a fire or a wind like that. It's like you were guilty by association, and here you are.
Okay. Okay, so now here's kind of what everybody's clued in for.
Yeah.
We want you to put your Swami hat on. Not really, but we want it. You've seen a lot. 22 years, you've seen some different things, but let's just go back maybe just 5 years. What's our current landscape look like compared to 2020? The premiums, the exits of some of our major players, and just kind of, we are taping this, but we won't play it back for the it's not a channel WTHR News or anything like that, but just kind of, if you
Yeah.
don't mind giving us some of your ideas and on basically current landscape, and then what your forecast is on that, if you think.
Yeah, you look back, from 2020, 2018 and that stuff, watching this market as it's changed. And, that's a nice thing that, for us that having a perspective, even on the national side and for what CAI does and what we do, like, we're spread out so many states. So we can watch what Indiana's doing, but we get to really get a feel for what's happening on a much broader spectrum, than what you're seeing here. So, seeing the trends, what they would say is like what industries goes, they say you have a hard market and a soft market. Well, the soft market is when everybody was just giving away policies for free. There were so many carriers that was in this niche. there was so many agents that were writing it. Well, then Indiana's horrible for hail. We all know it is. But then the loss ratios got out of control. The amount of claims got picked up. What we saw, the first tick we saw the biggest issue in was the directors and officers industry. The amount of lawsuits that was happening to boards, and a lot of, again, was discrimination. We started seeing that tick really hard in 18 coming into 19. You take in COVID, through the roof, absolutely through the roof. The amount of directors and officers claims that happened during that period was unbelievable. A lot of it was because people were bored. So people that had never read their documents before decided to read the documents, and they decided to go after the people sitting on the board of directors. It was a fun time. So we saw even some large carriers that were just specifically directors and officers go, hey, the biggest step we saw is they stopped taking new builders, construction. Like if it was Pulte or Lennar, if it was a builder controlled, the amount of lawsuits that those builders were getting hit with during that period, we saw them back away. And so we started seeing now that was hardening. It was harder to get the insurance. Property was still okay. Like it was fine. We weren't getting a lot there. Then property started to churn at the end of the COVID cycle. So you get 21, 22, you started feeling it. 23, the Prince Yard, 23 to 24 got really bad. What I was being told for every carrier I looked at was going, you're going to be lucky if we take our foot off the gas pedal for rate increases. Initially, they said by January of 2026. And I went, oh, we're now hearing it's going to be maybe through 27, if not further. So a
Wow.
lot of it, what we saw is, like you said, carriers were backing out and pulling out. There was one of the bigger players that was around, like they just started non-renewing. And then, property managers and everybody was scrambling, going, we need coverage, we need this, we can't get it. Right now, a lot of carriers are going, hey, if you're with what they would call a standard carrier and you got a renewal, you should probably take it because new business is cut down. Carriers before, like if you're in a, what we would consider like a condo setting, and we've got, property values that can hit 50, 60, 70, 100 million really quick. A lot of carriers backed up and said, for reinsurance issues, we're going to stop at 20 million. If it's over 20 million, we won't take them as a new client. Don't care if it's brand new. We don't care if they've never had a claim. We won't take them. We've had some go to 25. We had a carrier walk in the office and said, we want to write condos. We'll go to 10 million. I'm like, then you don't want to write condos because I barely have a condo that's 10 million. It's a really
Right.
hard market. So when I was with Hanover a month ago with their executive directors, we were sitting in Carmel and we were talking about this too. And what they said is what they're seeing is what we would call non-standard. Like we go to the brokers that going, hey, the main carriers in your state aren't writing. The non-standard carriers are now picking up a lot of this business. And even Hanover, that was in this market for a while, said, we're seeing a lot of business go into that market that's getting stuck in that market, that it's not going to come out. So the days that you had a $50 million association for values and that you'd be paying like, $40,000-$50,000 a year, that same 50 million now is going to cost you 100. If you're lucky, 100. I'd say you're pushing like 150 to 200 if you don't get stuck with a standard carrier. If you start having claims and stuff gets bad and they're done, you have to be prepared because prices have doubled and tripled. Even on the personal market side, like everybody get happy with auto, they're not happy with home. Anything that's got a roof in it, rates are still going to continue to go up.
Are you seeing, so what we're seeing a lot of these things is, and I don't remember, not that I didn't pay attention before 18, like you said, but probably I didn't as much. But now it seems like everybody's got some sort of percentage-based deductible.
Yeah.
And is that really the norm we're going to get no matter what? You're going to have your standard deductible of 10, 20, $30,000. But if it's a certain kind of event, we're going to have a percentage on top of that.
Oh, you're going to see two different waves coming in for this, not even for
Okay.
based off the deductible. So yeah, the percentage wind hail is coming. Travelers started that back before anybody else, and they tried to push the market. They started with a 1%. And the way that works is say you've got, it's 1% of the total insured value of your property or what is damaged. If every building in that association gets hit and you have $50 million in values, you pay 1% of 50 million is your deductible. You quick on math on that?
No, I'm not going to do math on that.
500,000.
I went to Butler. We didn't do math at Butler. Yeah.
So
Yeah,
500,000,
that's a lot.
yeah. So how many associations you that's got the reserve set there to take a $500,000 claim? So and that's at 1%. What we're seeing now is 2, even a 3%. The next catch that you're going to start seeing, and again, Travelers tried to push this and they got pushback. More carriers are jumping on, and we're even seeing it on our personal line side. You have a 3-tab shingle on your building, good luck getting insurance.
Interesting.
They won't touch it. You have a roof now. We have carriers that if it's a 3-tab older than 10 years old, they won't take it. If you have a dimensional shingle, some of them are going to start cutting off at 15 or 20. What we're seeing is they're going, hey, if we take it after 10 years, some of them after 15 years is not going to do replacement costs on roofs anymore. They're going to do actual cash value. Let's say you have a quote unquote 30-year shingle. You're at 15 years. You have $1 million claim. They're going to pay you 500,000. You get 50% of what the estimated life cycle that is. So you're going to have to come up with money. What the issue is what they're looking at it. And I get it. That's what we pay insurance for. Again, I am a consumer 100%. I do. But they're not a not-for-profit. So where they're having problem is every time, and Indiana's great for it, every time somebody's like, oh, there's hail coming into town, man, everybody's outside doing a hail dance. Hit my house. I need a roof. I need a roof. I need a roof. I get it.
Yeah.
$20,000 for a roof anymore. It used to be $5,000. Now it's 20,000 for your average roof. So everybody's going, I don't want to throw $20,000 on my roof. I hate buying car tires, let alone put a roof on it. Does me no good. What they're going to do is start doing, they're going to start depreciating the value of your roof. So you're going to have to start building reserves, and you're going to have to do this because they don't want it to be nickel and dime of going, hey, we had some shingles go off. The contractor's going, yeah, we can get you a whole new roof. And they're going to go, oh, no, we'll give you 50%. Good luck. So the wind hail's coming in and the actual cash value on your roofs is coming.
Okay. Last question. And this is, we've gotten this. This is the last couple of years. I think I was getting it once a month. What if we can't find coverage? What if your carriers, there's nobody local, you've gone through everybody, nobody's going to cover you because you've had water damage, you've had, just issues the last 5 years, you're uncoverable locally. What's the alternatives? What's the steps the board should take? What's the next step on something like that?
Yes, traditionally what we see is when we get into your borderline and what we would call your standard carriers, the people you're seeing advertising on the billboards and across your TV, and you think of standard, that's kind of what you see there. Then they're going, hey, we don't want to play. There's a next market that we would call is going to a broker. They have what they would call non-standard carriers that go, hey, we're not admitted truly the right in your state, but for a premium, we can pay tax to the state of Indiana. We can do this and we'll charge you more and you can get it. We had a recent one and I felt horrible for them. They literally had, what was it, like $48 million in coverage. And we got them a proposal, but it was $250,000.
Wow.
They had a budget of 80,000.
Yeah.
Now, the hard thing is you step outside to a broker. When you go into those worlds, and here's the worst other thing is, there's no payment plans like you are with, Travelers and Erie and Nationwide and the State Farm and, and everybody else, where they're like, oh, you want to pay quarterly or monthly? Great. Now the broker's like, we want our money up front. Well, I ain't got $250,000 laying around. So then you go, Travis, they don't have $250,000. And I'll go, hey, you know what? I'll finance your insurance for you. So we're going to apply and we're going to take out an insurance loan. And we're going to go to a carrier and they're going to go, okay, you guys have to put 10% down. We're going to give you 10 installments and your interest rate is going to be a whopping 18 to 24%.
Wow.
But you can pay it off early if you want with no penalty.
Incredible. Okay.
Yeah. So
but that's where we just need to keep our eyes on, and that's where the risk management.
That's a lot of it. Where is like you're talking on the deductible. I was going, back in the day, there was a lot of people was like, hey, I had a $500,000 deductible and it was big. State Farm, you would have one claim and they'd raise you to 25,000. And man, I got so much business off of it because I was like, oh, that's horrible. I hate to say it now, but 25,000 is like the new norm.
Yeah, it is.
And the biggest thing is you have to be willing to go, hey, we can shoulder some of this and not everything needs to go insurance. Again, I know that's what we pay for. That's what it is there. on their back end, they're going to go at some point when the profitability outweighs how much you've paid in, they're going to go, we're not making money. Will we make money? We can't take enough rate increases. You're either going to get canceled. So the policies need to turn into truly the thought philosophy needs to be these policies are for catastrophe events only.
Yeah.
We lost a handful of shingles, pay to get them fixed.
Yep. And that's where we need to we're seeing a lot of
We had a
that.
tree fall in the common area, pay to get it picked up.
Yep.
You
Yep.
know,
We don't want to keep doing that. Do you I had a really incredible question I was going to ask Travis, and I can't remember it right now. It was really just going to just close the whole thing.
yeah.
Standing ovation. Can't remember any of it. I do have. There's a couple questions, and then Brad Hessman's got a question. Don Shannon is asking, "Our HOA documents require HO6 policy. How many carriers do you have that want that business? Is that something where you have trouble getting those HO6s?
No.
So it should be
Uh,
all the carriers are going to
for
be.
for an HO6 side for you personally, no issues whatsoever. There's nobody in that market has balked whatsoever.
Okay. All right. I appreciate it. Brad Hessman. I'm going to allow Brad to talk. Brad is the board president of Heron Lake Homeowners Association, and he has lived through a lot of this kind of stuff, and so he has a question. I think you're good to talk, Brad.
Hi, Dan. Can you hear me okay?
I can. I can. Go ahead.
I've met Kelly a couple times, and so I have to assume it's congratulations and not deepest sympathy.
Thank you very
Okay.
much, Brad.
That's a
Congratulations.
little personal. Oh my gosh.
Hi,
Thank you,
Kelly.
Hi, Brad. Nice to see you.
Hey, congratulations to you both. Dan,
Thank
I've got a couple of, I just want to throw out sort of a bigger picture type question here. I was going to ask Travis to dive into the craziness that the insurance industry has become in the last 5 years, but he did it. And then I was going to ask him to talk about the 3% wind hail thing, and you covered that pretty much. Travis, I did the math. We'd be looking at $800,000 deductible for my community, which would wipe us out.
Yeah.
And I'm sure we are not alone. I'm sure there's other communities that don't have $800,000 just sitting around extra. So I'm not sure what the answer is on that, but I appreciate all your input and everything on both of those bigger picture subjects. Dan, my question. So what I'm going to do is I'm going to defer my question to you, Dan. Is there anything that KMC can do to help maybe legislatively bring this whole craziness of the insurance industry under control, or is that a pipe dream?
So I think Travis probably is going to be better at answering this. He's on the LAC committee, I believe, of the Indiana CAI. And so that's really where we would defer to CAI trying to help us on that with the local government. But go ahead, Travis. You probably could help on that.
Yeah, ironically, that was one of the conversations that I had with Hanover and Foremost and Travelers within the last 3 months. Sitting with their top execs and running into this stuff, and even Erie's talked about it, and that is good, bad, or ugly. Throw all politics out the window. The last thing that the insurance company wants to see is big government get involved to step in and go, hey, we want you to do this, do this. Prime example, first and foremost, is the state of Florida. I have a lot of family down there, and I have a lot of connections in that state that we try to write for. The legislative process is so hard in there. What it actually did was drive carriers out of the state that didn't want to do it. We have a business partner that's in New Jersey, and every carrier I have will not write in New Jersey. And that's because of the Department of Insurance on that aspect wouldn't let them take their rates to turn profit. And because they wouldn't take a profit, all the carriers walked out of the state and said, forget it. And we went, oh, so what they're wanting to do is go, hey, we know this is a problem. We know that this is growing, and everybody initially went when you came out of COVID, everybody on property, on auto wise, people started driving again and just threw it completely out of. Well, then you get into the world of you don't know what tariffs are and you don't know what's going to happen. Then when you get into the natural catastrophes, anything that happens in the Gulf of Mexico is going to affect us up here because majority of carriers that are riding here have exposures down there. So if they're not making money out the Gulf, they've got to make money up here. It is an absolute vicious cycle from coast to coast and all the way around until the overall labor costs when the labor starts filling back up, the cost of material starts coming back down, and the availability of material starts coming back down, um, we're not going to see it. You know, when Hannah even showed a report the other day that in between 20 and 24, the average cat claim through America, they averaged 17 a year. I'm sorry, it was 19 to 23. 24 and 25, we've already had average of 27 in the majority of them, which was here in the state of Indiana. So as long as that stuff keeps happening, the legislation can't even step in to try to help make them drive down the prices.
Okay. All right. One thing we have noticed, or actually the board is meeting tonight that they're going to start this year. They are going to start an insurance reserve, just to kind of start putting money aside, specifically for insurance, try and get to their deductible. I mean, I don't think anybody will ever get to it, but at least to have a good faith effort where they're putting money aside every year. And
Well, and
then,
there's some aspects that there are some carriers that will give you what you call a buyback. Depends on the carrier. So you technically are kind of buying another insurance policy. You're kind of going, hey, we have an $800,000 claim. So if we hit it, you know, do we have a much smaller, like you're buying an insurance policy on your deductible?
okay.
It's an odd market to get into. There are options there. Indiana's still not that big into it yet, but there are what they would call a buyback program, and there's stuff in there that you can look at depending on the carrier and what they can offer. But the only
Wow.
thing, unfortunately, to do is, as much as I hate it internally because it's a lot of stuff, it's a lot of work to do, is you just got to keep keeping them honest. You know, talk about
Yeah.
your deductible, but just kind of go, hey, as much as I hate to say it, I will tell you this. Everybody knows, even property managers, if somebody finds out a carrier is hot, they're going to run to them
Yep. Yep. We
until
see
they
that.
will, until they'll no longer take business, and
Yeah.
then they run away. So
You know, it's interesting how many terms we're using tonight actually work in Las Vegas. As far as we're buying back, we're
yeah,
got some insurance. We've got this. It's a tough business. It just nobody knows where anything is. One last
yeah.
question, and I don't know if this is something we could answer, but it is. This HOA insurance increased for 2026. For reference, his policy went up 30% from 24 to 25. As you said earlier, you kind of touched on that you feel like they're not going to take their foot off the gas till 2027 at this point. So,
Single family HOAs, we haven't seen get hit as hard, just because the exposure is not as big. The biggest exposure I have on a single family is liability. You know, that's where it's at. Are those prices still gone up? Yeah. Have they gone up as dramatic as something with a roof? No. Yeah, you take anything that's carrying heavy roof exposure, I'm still seeing probably another 20 or 30% easily this year.
okay. All right, Travis, this was wonderful. I appreciate your time. If anybody has any more questions, they can email it to us tomorrow. This is Travis's information is on here. You can find him anytime during the week, and this is what he does. This is not a part-time deal for him. This is all day, every day. And then Kelly and I are on the back here, so we will send this all out to everybody in the next probably 2 business days at the latest. But I really appreciate everybody's time coming out on this beautiful Sunday night, and we will talk to you all later. Thank you very much.
Thank you, everyone. Thank you, Travis.
Thank you,
Very
Travis.
much.
Really
Yes,
appreciate it.
appreciate it. Thank
Wonderful
you.
presentation. Thank you.
Thanks.